If you have an RRSP, there's a critical deadline you need to know about. December 31st of the year you turn 71. After that date, you can no longer have an RRSP. So, what happens to your retirement savings? Today, we're explaining RRIFs, Registered Retirement Income Funds, and what you need to know before you turn 71. Let's start with the deadline. By December 31st of the year you turn 71, you must close your RRSP. You have three options: convert it to a RRIF, buy an annuity, or withdraw it all as cash. Most Canadians choose the RRIF because it gives you the most flexibility and control. If you do nothing, your financial institution will automatically convert your RRSP to a RRIF, but it's better to be proactive and make the decision yourself. So, what exactly is a RRIF? RRIF stands for Registered Retirement Income Fund. Think of it as the next phase of your RRSP. It holds the same investments: stocks, bonds, GICs, mutual funds. But instead of contributing money like you did with your RRSP, you're now required to withdraw a minimum amount every year. The good news? You keep control of your investments. You decide how the money is invested, and you can withdraw more than the minimum anytime you want. The conversion from RRSP to RRIF is straightforward and tax-free. Your investments simply transfer from your RRSP account into a RRIF account. Nothing is sold, no taxes are triggered by the conversion itself, and your money continues growing tax-deferred just like it did in your RRSP. You can do this conversion at your bank, credit union, or investment firm where your RRSP is held. Most people do it in the year they turn 71, but you can actually convert to a RRIF as early as age 55 if you want to start creating retirement income sooner. Here's the key difference between an RRSP and an RRIF: mandatory minimum withdrawals. Starting the year after you convert to a RRIF, you must withdraw a minimum percentage of your account balance every year. This percentage increases as you get older. The government sets these percentages to ensure you gradually draw down your retirement savings and pay tax on them. You don't have to take withdrawals in the year you convert. The minimum starts the following January. Let's look at the actual percentages. At age 71, you must withdraw 5.28% of your RRIF balance. At 75, it's 5.82%. By age 80, it's 6.82%. And it keeps increasing. By 95, you're required to withdraw 20% annually. For example, if you have $200,000 in your RRIF at age 72, your minimum withdrawal for that year would be 5.4%, which equals $10,800. Now here's the part many people forget. All RRIF withdrawals are fully taxable. Every dollar you withdraw from your RRIF gets added to your income for that year and taxed at your marginal tax rate. This is true whether you take the minimum or more than the minimum. Your financial institution will withhold tax on amounts above the minimum: 10% on amounts up to $5,000, 20% between $5,000 and $15,000, and 30% over $15,000 in most provinces. But your actual tax owing depends on your total income when you file your tax return. The minimum withdrawal itself has no withholding tax, but you still owe tax on it when you file. Remember, the percentage is a minimum, not a maximum. You can always withdraw more than the minimum if you need extra money. For a trip, home repairs, helping family, or any reason. There's no penalty for taking more, though you will pay tax on the full amount. Many retirees take only the minimum to keep their taxable income lower and preserve their capital longer. Others withdraw more if they need the cash flow. What about the other option? Buying an annuity. An annuity is when you give an insurance company your RRSP money and they guarantee you a fixed monthly payment for life. The advantage is guaranteed income with no market risk. The disadvantages are you lose control of the money, you can't change the payment amount, and typically nothing is left for your estate when you die. Most Canadians prefer the RRIF because it keeps them in control and preserves their capital for their spouse or children. Here's a tax benefit. RRIF income qualifies for the pension income tax credit. If you're 65 or older, the first $2,000 of RRIF withdrawals qualify for a federal tax credit worth about $300, plus provincial credits. This is non-refundable, meaning it reduces your tax owing. Even better, RRIF income is eligible for pension income splitting with your spouse, which can save you significant tax if one of you is in a higher tax bracket. We have a separate video on pension splitting if you want to learn more. Let's talk strategy. When you set up your RRIF, you can base the minimum withdrawal percentage on your spouse's age if they're younger. This means lower required withdrawals, keeping more money growing tax-deferred longer. You should also coordinate RRIF withdrawals with your other income sources, CPP, OAS, employer pensions, to minimize total taxes and avoid the OAS clawback if your income gets too high. Keep your RRIF investments appropriate for your age and risk tolerance. Many retirees shift toward more conservative investments like GICs and bonds in their RRIF to reduce volatility. What if you don't need your RRIF withdrawals to live on? You still have to take them out, but you can reinvest the after-tax amount in your TFSA if you have contribution room. This shifts money from a taxable account to a tax-free account over time. You could also gift the money to children or grandchildren, or donate it to charity and claim the donation tax credit to offset some of the tax on the withdrawal. So, to recap, by December 31st of the year you turn 71, you must convert your RRSP to a RRIF or another option. A RRIF requires annual minimum withdrawals that increase with age. All withdrawals are taxable, but you keep control of your investments and flexibility. And RRIF income qualifies for pension credits and income splitting. As always, this is educational content, not financial or tax advice. Your RRIF strategy should consider your total retirement income, tax situation, and goals. Consider consulting a financial advisor or tax professional. If you found this helpful, check out my videos on CPP, OAS, and pension income splitting. Thanks for watching.